Hey guys, welcome back to the Independent Investor Channel. My name is Ryan, coming to you from the Big Apple, New York City, New York. So good to be with you again. We're going to be talking about compounding interest on this video. This is one of the very most important things to understand about realizing the power of money. Realizing that when you put your investment dollars away, it has the potential to grow over time and actually pay you back the longer you have your money in those investments. And the term is called compounding interest. And Einstein referred to compounding interest as one of the ninth wonders of the world, and it really is. And it's one of those things that's actually really difficult to understand if you're starting out in investing, right? But if you just take a little bit of time to kind of understand the powers of compounding interest, this can really be the singular validation that you need to start investing. I know that it was for me. When I found out about the power of compounding interest and I started to do a few calculations like the one I'm going to work through with you guys now, it really opened my eyes to the power of how money, if put away correctly, can really work for you, all right? And it works for you harder the longer that you have that money put away. All right, so what I've got here is I've got three scenarios, and before we get started, I got these scenarios using a tool off of the Trading Academy online. It's a link that I'm going to provide at the bottom of this video for you guys to go into and kind of input certain data points, and you guys can play with these numbers, all right, to kind of make it fit your particular portfolio or your particular plan going forward. These are just some of the numbers that I use, guys, so please enjoy. This will be one of the very most important videos that I come out with on compounding interest, so please enjoy, all right? For the scenario that we've got here, the three scenarios on the board, what we're going to do is we're going to run those scenarios based on a couple of factors, okay? We're going to look at a 40-year investment time horizon. So for you guys out there that are in your early 20s, we're going to look at, starting at 20 years old, and that should put you at, around 60 years old, which is around the maturity date of 59 and a half that we talk about all the time for the self-managed Roth IRA account, okay? So we're gonna talk about a 40-year time horizon, and we're going to anticipate a 7% interest rate of return year over year, okay? Now, realistically in the market, you're not gonna get 7% every year, okay? Some years are gonna be up and other years are gonna be down, but what we're hoping for is a year over year average of 7% every year as your dollars are growing, okay? So the first example I've got up here is identified in green, and it's assuming that you take $1,000 looking to start your investment account, okay? So a one-time initial deposit or funding of the account of $1,000, okay? And we're going to assume, we have here in blue, that you take $50 and you invest those $50 every month, all right? So the figure in blue represents your monthly contribution to that account, all right? So if we started with $1,000 and we invested $50 a month for 40 years, and it just went directly into a savings account, that's going to render $25,000, okay? 0% interest, no compounding interest, no effect on that account whatsoever. In 40 years, you're going to end up with $25,000, okay? Now, this is where the choice piece of the exercise comes in, and we split off here. And what I've done here, for example's sake, is on the top line, I've got an expense ratio of 0.2%, all right? So if we award a 0.2% expense ratio, what is that going to mean if we have an initial $1,000 deposit, $50 a month, and we charge a 0.2% expense ratio to that account, basically the fees, okay? Now, on this particular account, or on this particular channel, we talk all the time about the VOO, which is the ticker symbol for the Vanguard ETF. It's an ETF that tracks the S&P 500. The expense ratio on that account is actually 0.05, all right? So 1/4 of the 0.2% that we're using here in this example, okay? So if we run this out and we charge this account 0.2%, that's gonna actually render back to the original investor $131,000 in 40 years, okay? So we come down here and we just move the decimal place one place here, and we award an expense ratio of 2%. And this will start to give you an idea of the effect on fees in any investment account, all right? So if we do a 2% fee here, that's going to render back $81,000 to the original investor if all things are constant, all right? So you can see here, just for example's sake, the difference between $131,000 and $81,000 is $50,000 of difference, okay? So you can kind of start to see here the effects here in your decision making and the importance of keeping fees to a minimum, okay? So the second example we've got here is kind of the same idea, all right? But what if you had a little bit more to invest, okay? What if you had an initial deposit amount of, let's say, $10,000, okay? Because some people do. Some people have saved up and they're ready to start investing, and they actually save for quite a while before they start to, you know, really get serious about making that commitment, okay? So if you start out with $10,000, and we go ahead and up the monthly contribution to, let's say, $100, just for example's sake again, all right, in orange, over 40 years with no capital appreciation, you're going to have $58,000 in that account, okay? And again, we run this out with the expense ratio here identified in red, the top being the 0.2%, all right, over 40 years of investment, $10,000 initial, $100 per month, 0.2% expense ratio is going to render the original investor $374,000. Okay, not bad. All right. Now we come down here to this lower bracket and we go ahead and affix a 2% fee to this scenario here. That's going to render back $219,000. All right. Now you're thinking, okay, well, $219,000, that's 4 times this amount with 0 capital appreciation, guys. But the reason why we come out with the Independent Investor channel and the reason why we talk about this, and this is so important to understand, is look at the difference between these two accounts, guys. And this is just by nature of choice. The difference between these two amounts, just the effect of this 0.2 and 2% fee is $155,000. Guys, that's astonishing, okay? And this is just by nature of choice. We can avoid these mistakes just by nature of the account that we put our money in to make sure that we're eliminating fees and we're tax protecting money going forward, okay? We can avoid this right here just by nature of free choice, okay? Now, the last example we've got here is for the majority of folks out there. You know, it's for people just starting out. I know when I started my investment career, I started with $1,500. I didn't have $10,000 to start, and a lot of people don't, and that's all right. All right, so we're going to drop this initial amount down to $1,000, okay? But what we're going to do is we're going to push this monthly contribution up to $458 a month. And you think, wow, that's a lot, okay? That's a lot. But for example's sake, this $458, guys, is the maximum contribution to your Roth IRA. And on the Independent Investor channel, we talk a lot about the self-managed Roth IRA, all right? The self-managed vehicle is going to allow you to eliminate the fees altogether, all right? So this basically is just taking an example and assuming that you're maximum contributing to your Roth IRA, all right? So we take the $458 and we contribute that monthly, all right? If we just went straight into an account, we'd have $220,000. That's with 0 capital appreciation, guys. But this is where it really gets interesting. Look at the effect of this. $458 a month awarded a 0.2% expense ratio is going to render you $1.1 million after 40 years of investing, okay? $1.1 million compared to $220,000 without the effect of this compounding interest. This is the key. This is the key to investing. This is why people invest. If you're looking for any sole validation out there as to why you invest your dollars, this is why you do it, guys, because this is the math of it, all right? You can argue all you want about getting to this 1.1 million, but this is mathematics, guys. This is just what it is, okay? I'm not making this stuff up. This is not magic, okay? But if we look at this bottom bracket here and we go across, look at the difference between this 0.2% expense ratio on this account and the difference here if we just move it one decimal place again, assign a fee of 2%. Guys, remember, I always stress that I always stress the importance that the industry standard for fees in the investment world is actually 3% or a little above 3%, all right? And I contend that most people actually end up down here on this lower bracket and fail to realize the true power of compounding interest going forward, all right? Most people end up down here, and the sheer difference between this 1.1 million and the 689,000, guys, we're at $411,000 of difference, guys. 411,000. That is way too close to $500,000, guys. Way too close to $500,000. And it's all just by nature of choice, right? That we can avoid this right here and be up here and minimize that expense ratio within that account. All right, guys, and just listen, thank you so much for tuning into the Independent Investor channel. If you have not subscribed to the channel, I highly encourage you to do so. You'll be notified of any future videos that I come up with. I'm kind of starting a new initiative. If you have comments, I would love for you to leave those comments down in the bottom section, guys. I respond in detail to every one of them, and I actually see that that's kind of where the vision of where I want to take this channel is, to be so much more interactive with you guys, really, because if you have concerns or if you have, reservations about investing, guys, throw those my way. Throw those my way. Another opinion, it never hurts, right? I've been investing in the market for over 2.5 decades, guys, and asking for my opinion just will never hurt anybody, guys. Hit the thumbs up button, and if you'd be so kind as to share this link with anybody who you think would benefit from this information, I would very much appreciate it, guys. Thank you so much again for tuning in, and good luck in your investment futures.